12 critical stock market mistakes that are destroying your portfolio. Hey everyone, welcome back to the channel. I'm First Dollar Investor, and today we're diving deep into something that could save you thousands of dollars. Did you know that 70% of retail investors in the US stock market lose money? That's a staggering statistic. But here's the thing, it's not because the market is rigged against you. It's because most investors keep making the same critical mistakes over and over again. Today, I'm breaking down the 12 most devastating stock market mistakes based on the latest behavioral finance research and real market data from 2025. If you can avoid these mistakes, you'll immediately put yourself ahead of 70% of other investors. So stick around until the end, because I'm also giving you a practical action plan to implement these lessons starting today. Let's jump right in. Emotional decisions. Mistake 1. Making emotional investment decisions. The number one mistake that destroys portfolios. Emotional investing. Recent studies from 2025 show that 85% of investors make panic sells or FOMO buys. That's fear of missing out purchases. This is what behavioral finance experts call herd mentality. When everyone's selling, you sell. When everyone's buying, you buy. But here's the brutal truth. By the time everyone knows about it, it's usually too late. What's the solution? Create a written investment plan before you invest a single dollar. Set your stop loss and profit-taking levels in advance. Focus on 3 to 6 month trends, not daily fluctuations. Base your decisions on data and analysis, not market news or social media. Remember, the market rewards patience and punishes emotion. Warren Buffett didn't become a billionaire by panicking every time the market dropped 5%. Investing without research. Mistake 2. Investing in companies you don't understand. Mistake number 2. Buying stocks based on tips from your neighbor or Reddit. Say no. My buddy made a killing on the stock, I should buy it too is basically gambling, not investing. According to JP Morgan's 2024 research, investors who buy without research underperform the market by an average of 23%. What should you research before buying any stock? The company's financial performance over the last 3 years, key metrics like P/E ratio, debt to equity, and profit margins, the company's position in its industry and competitive advantages, future growth projections and expansion plans, management quality, and track record. Here's Warren Buffett's golden rule: never invest in a business you cannot understand. If you can't explain what the company does to a 10-year-old, don't invest in it. Portfolio diversification. Mistake 3. Putting all your eggs in one basket. Third critical mistake. Lack of portfolio diversification. Putting all your money into one sure-thing stock is like playing Russian roulette with your financial future. As Check Capital Management CEO Steven Check says, concentration can make you rich, but diversification keeps you rich. Here's how to properly diversify. Invest across at least 8 to 10 different sectors. Mix of 60% large cap, 40% mid to small cap stocks. Never put more than 10% of your portfolio in a single stock. Always keep some cash reserves for opportunities. According to Waverly Advisors research, diversified investors experience 15% less volatility and achieve more consistent long-term returns. Don't be the person who had everything in tech stocks during the dot-com crash or everything in real estate in 2008. Get rich quick mentality. Mistake 4. The get rich quick delusion. Expecting to get rich overnight. Those Instagram posts showing 500% gains in 1 month are either fake, extremely lucky, or about to be followed by massive losses. Don't fall for it. The stock market is a marathon, not a sprint. Here's a reality check. Warren Buffett made 99% of his wealth after age 50. That's the power of compound growth over time. Set realistic expectations. Target 10 to 15% annual returns, not 500% monthly gains. Think in terms of 5 to 10 year time horizons. Minimum. Focus on steady growth, not lottery tickets. Patience and discipline are your biggest advantages. Studies show that long-term investors achieve positive returns 78% of the time, while short-term speculators only succeed 22% of the time. The stock market is a device for transferring money from the impatient to the patient. Investing with borrowed money. Mistake 5. Investing with borrowed money. Fifth critical mistake. Using credit cards or loans to invest. This is financial suicide. The money you invest should be money you won't need for at least 2 to 3 years, period. Why is borrowed money so dangerous? You're forced to sell at the worst possible times when you need cash. Interest payments can wipe out any gains you make. Psychological pressure leads to terrible decisions. If you lose, you still owe the money plus interest. Data shows that 73% of investors using borrowed money end up in the red within 1 year. The right approach: only invest money you can afford to lose completely. Build an emergency fund covering 6 months of expenses first, then start investing with surplus money. Remember, you can't go broke taking profits, but you can go broke chasing them with borrowed money. Day trading trap. Mistake 6. The day trading trap. Mistake 6. Day trading. Trying to make quick profits with frequent buying and selling. Here's a sobering statistic: 80% of day traders lose money in the long run. The house always wins. And then, Day trading, the house is the combination of fees, taxes, and your own emotions. Asterisk why day trading destroys wealth. Trading fees eat up your profits. Emotional decisions multiply when you trade frequently. Asterisk you miss out on long-term compound growth. Asterisk creates stress and consumes enormous amounts of time. The average day trader underperforms a simple index fund by 6 to 8% annually. Asterisk the better strategy. Adopt the buy and hold approach. Make no more than 1 to 2 trades per month. Asterisk factor in all costs, commissions, taxes, spreads. Asterisk be an investor, not a gambler. Time. In the market beats timing the market, every single time. Asterisk emotional attachment to stocks. Mistake 7. Falling in love with your stocks. Asterisk 7th mistake. Getting emotionally attached to your investments, saying this stock is special to me. It has to go back up while watching it bleed red for months. Is it? Investing, it's wishful thinking. This is called the endowment effect in behavioral finance. We overvalue things simply because we own them. Asterisk. How emotional attachment hurts you. You can't make objective decisions anymore. You refuse to cut losses when you should. You miss other opportunities while waiting for a dead stock. Asterisk hope becomes your investment strategy. The right mindset. Stocks are tools, not pets. Every position should be regularly evaluated. If the fundamentals change, or if there's a better opportunity, don't hesitate to make a change. Professional investors review every position quarterly and ask, if I had cash today, would I buy this stock at the current price? If the answer is no, they sell. Portfolio rebalancing. Mistake 8. Ignoring portfolio rebalancing. A mistake. Never rebalancing your portfolio. Market movements change your portfolio's allocation over time. That 10% position from 6 months ago might now be 25% of your portfolio because it performs so well. JP Morgan Asset Management research shows that investors who rebalance regularly earn 3 to 5% higher returns annually. Asterisk when should you rebalance? Review every quarter. Rebalance when any holding exceeds your target allocation by 5%. Asterisk definitely rebalance at least twice per year. Asterisk how to do it. Sell positions that have grown to large. Asterisk buy more of positions that have shrunk. Asterisk return to your target allocation. This discipline might seem boring, but it's incredibly powerful. You're systematically selling high and buying low, which is exactly what successful investing is all about. Asterisk exit strategy. Mistake 9. No exit strategy. Mistake. Not knowing when to sell. Most investors spend hours researching when to buy, but never plan when to sell. This is backwards. Asterisk why an exit strategy is crucial. Protects your profits from market reversals. Asterisk limits your losses before they become devastating. Asterisk removes emotion from sell decisions. Gives you clear, actionable targets. Asterisk essential selling rules. Set your target. Sell price when you buy. Use stop losses at 10 to 15% below your purchase price. Asterisk consider taking profits at 25 to 30% gains. Asterisk use stage selling. Take some profits, let some ride. Asterisk studies show investors with clear exit strategies outperform by 40%. Don't let a 30% gain turn into a 20% loss because you didn't have a plan. Asterisk waiting to break even. Asterisk mistake number 10. The break-even trap. Mistake. Waiting for losing stocks to break even. This is called loss aversion in behavioral finance. We hate realizing losses so much that we'll hold losing positions way longer than we should. Waiting for a stock that's down 20% to get back to your purchase price is a massive mistake. Because, asterisk why? The break-even mentality destroys wealth, creates opportunity cost. Your money is trapped in a loser. Asterisk you can't redeploy capital to better opportunities. Asterisk creates psychological stress and poor decision-making. Often leads to even bigger losses. Asterisk the right approach. Accept the loss and move on quickly. Asterisk redeploy that capital into better opportunities. Asterisk don't fall for the sunk cost fallacy. Asterisk set maximum loss limits for every position. Asterisk research shows that investors who cut losses quickly outperform by 18% over the long term. Your first loss is usually your smallest loss. Emotional control. Mistake 11. Losing emotional control. Asterisk 11th mistake. Losing emotional control over your investments. Checking your portfolio every hour when you're down. Losing sleep over market moves. Constantly reading financial news. These are signs you've lost emotional control. Asterisk warning signs. Checking your portfolio 10 plus times per day. Asterisk losing sleep over market movements. Asterisk your mood swings with your portfolio value. Asterisk neglecting relationships and responsibilities. Asterisk how to regain control. Check your portfolio weekly, not daily. Stick to your investment plan no matter what. Asterisk develop hobbies and interests outside of investing. Asterisk take breaks from market news and social media. Remember, 80% of investment success is psychological. If you lose emotional control, you'll lose your money too. The stock market is designed to transfer money from the emotional to the unemotional. Asterisk stopping education. Mistake 12. Stopping your financial education. Final mistake. Thinking you know everything. The market constantly evolves. New strategies emerge. Sectors change. Economic conditions shift. The moment you stop learning is the moment you start falling behind. Asterisk how to keep improving. Read investment books regularly. Follow reputable financial analysts and research. Asterisk learn from experienced investors. Attend investment seminars and webinars. Asterisk analyze your mistakes and successes. Studies show that investors who continuously educate themselves achieve 65% better long-term results. Asterisk, remember, the best investment you can make is in yourself and your financial education. Warren Buffett reads 500 pages every day. If it's good enough for him, it should be good enough for us. Asterisk, conclusion and action step show to avoid these 12 costly mistakes. There you have it. The 12 critical mistakes that destroy investment portfolios. But knowing about them isn't enough. You need to take action. Asterisk, your immediate action plan. 1. Write down your investment plan, goals, timeline, risk tolerance. 2. Build an emergency fund to 6 months of expenses before investing. 3. Only invest in companies you understand. Do your research. 4. Diversify across at least 8 to 10 stocks. Don't put all eggs in one basket. 5. Set stop losses and profit targets. Know when to sell before you buy. Asterisk, daily habits to develop. Check your portfolio weekly, not daily. Focus on analysis, not market noise. Never make emotional decisions. Never stop learning and improving. Asterisk, if this video helped you avoid even one of these mistakes, it could save you thousands of dollars. Hit that like button, subscribe for more investing content, and let me know in the comments which mistake you've made before. We've all been there. Asterisk, thanks for watching. And remember, successful investing isn't about being perfect. It's about avoiding big mistakes. See you in the next one. Asterisk.